Welcome back to For Real Finance. In this video, I'll be breaking down how much you need to make in order to afford a 2023 Toyota 86. You should really consider following one of these rules in order to avoid making a huge mistake that'll end up setting you back for years to come. I've also got a link to a free auto insurance quote where you could save up to about $600 a year or just lower your insurance down in the description below, but more on that later. There are 4 options that I'll be going over today. You can decide on which one suits you the best depending on how into cars you are. Some people just want a reliable form of transportation, something cheap, going to take them from point A to point B reliably, and some are willing to sacrifice quite a lot more and spend quite a lot more in order to get the car that they really want. Stick around to the end of the video to find out what method would be best for your personal preference and situation. This is For Real Finance, a channel dedicated to helping you make smart financial and car buying decisions. Before I dive into the first rule, these videos take quite a lot of time and effort to make. Please give it a like, subscribe, comment down below what other vehicle that you would like me to review. First rule I'll be going over today is the 24-10 rule, and this states that you must put at least 20% down on the car. You shouldn't finance it for more than 4 years or 48 months, and the payment shouldn't be more than 10% of your monthly gross income. The 2023 Toyota 86 has an MSRP of about $27,900, and this would mean you should put down about $5,500. With the average new vehicle interest rate hovering around 3.86% and a 48-month term, this would bring your monthly payment to $502. Take note here that you're also paying about $1,800 in interest over the life of the loan. Bankrate states that the average monthly insurance cost is $148 a month, but this varies a ton from person to person. How old you are, where you live, your gender, your driving habits, etc. So give a look at that smart financial link down there. It's completely free auto quote. See if you can save a little bit of money. This brings your monthly total to $650.57. Going back to that 24-10 rule, this would mean you need a monthly gross income of $6,500, which would add up to about $78,000 a year annually is how much you would need to make. I really encourage you to take a look at the opportunity cost here. If you were to buy a cheaper $5,000 or $10,000 car, something really cheap and reliable in cash, and put what would be your car payment of $502 in the market instead, over the course of 5 years with a relatively conservative 6% rate of return, this would turn into about $35,000, making about $5,000 here in interest alone. Give a look at those Acorns and M1 Finance links I've got in the description below. It's super easy to get started investing, and I highly encourage you to get started as early as you can. Even if it's a small amount of money, it could turn into something pretty special over a long period of time. And again, this is just for the first 5 years. To give you a little bit better of an example, for 10 years, this would turn into about $82,000 if you were to keep investing that $500 a month. Again, at that 6% rate of return. And for reference, the stock market averages around 10% return per year. So that 6% that I'm using in this calculation is pretty dang conservative. The next rule I've made up here is my own. And for my rule, I think you should have at least a 6-month emergency fund, invest 15% of your monthly gross income into your 401k, and max out your Roth IRA and really ideally your HSA as well, but I'll leave that as optional. And I know that it does seem like a ton of saving, and honestly it kind of is, but I don't give you a monthly percentage rule that you have to stick to in terms of like spending beyond this. So once you hit these guidelines, I'm not going to tell you what to spend your money on. It's up to you to decide if you want to spend more on a vehicle or if you're not really into cars and you'd rather go on more vacations, go out to dinner more, buy more junk on Amazon, etc. So once you hit those saving goals, I'm not going to tell you what to do. And that 6-month emergency there is just there in case, obviously, an emergency or anything crazy happens, especially if you got all these payments, car payments and whatnot going around. It's nice to have a little bit of an emergency, especially if you are in an industry such as sales or commission-based, something that's not super secure on a month-to-month basis. And there's a lot of people out there that argue with me and say that, hey man, nothing's guaranteed. You should live your life how you want to now. And you know, it's definitely true that nothing's guaranteed, but the average American lives to about 78 years old. And you're going to need that money at some point, statistically speaking. So you should probably get started saving now, even if it's not a ton of money. Next rule I'll be going over is the Dave Ramsey rule. He's kind of unpopular in a lot of car guys' opinions, but he thinks you should have at least a 3 to 6 month emergency fund built up. The vehicle should not be more than 50% of your annual gross income, and you should purchase it in cash. Given that 2023 Toyota 86 starts at about $28,000, you would need to make about $55,000, $56,000 a year. And ideally, it's nice to buy a vehicle in cash. There's a lot of perks to that. You'd avoid having to pay $1,800 in interest. Your insurance is going to be lower. But then again, you got to fork over 28 grand all over in cash here. And there's a chance if you put that money in the market instead, that it's probably going to make a little bit more money. Final rule I'll be going over is the 1/10 rule, which is developed by Financial Samurai. This is a pretty old blog and very popular blog, so you might have heard of this before. Personally, I want to think that the majority of people that are trying to build their wealth as quick as they can should really consider. It really doesn't allow you to buy a new vehicle, but it's set up to help you spend responsibly, which reduces your financial car ownership stress and increases your net worth quicker over time. It's a pretty straightforward rule. It states that you should not spend more than 10% of your gross annual income on a car, so it's pretty dang stringent there. In this case, in order to buy this car, you need to make about $280K a year. So it's not super popular in terms of new cars, and you need to own that for at least 5 years too, but ideally more. And the theory behind this here is to minimize your financial stress. It frees up a little bit of money to invest in assets or other opportunities that are going to come across your way. It's nice to have the cash there, and then you can deploy it when you have an option come your way. It's a lot more stressful and difficult making those super important life decisions when you've got payments kind of weighing over your head every single month. And so that's what this rule is for, is to really not have any payments, to have a lot of money in case anything else comes up. So you can jump on that with a cash deal. Once again, this is 4 Wheel Finance. If you've got any questions regarding car buying or how much of a car you can afford, please leave them down there in the comments below. Don't forget to go look at that Smart Financial link. Super quick, easy to fill out, takes like 20-30 seconds, and it's completely free. See if you can save a little bit of money on your